Hi, it's Dave Lotan. This is SF Live, episode 274. I'm a strategic investor, CEO of LHI Capital, and happy to be here with Kai today to discuss these turbulent markets.
Fantastic, Dave. Great introduction to the show. Much appreciated. Probably the best one we had so far. So really appreciate it. Thanks for coming on. I've been really looking forward to having you on the program. It's been a while coming, and to be honest, this is my highlight of the day. Looking at the markets. Absolutely. I was chatting with somebody this morning. I was like, why am I even going to the office? And I was like, hey, I got something to look forward to. And it's this conversation. So thanks for coming on, and thanks for being my highlight of the day.
Well, if I'm your highlight of the day, Kai, that's a giant buy signal.
Really, it probably is. If looking at my portfolio, I've just opened my TMX Power Stream for the first time in probably 2 weeks, because I'm not a trader usually, but today there was an event where I had to do something. And I looked at it, it was just all red, like not very positive, not very happy with that. But Dave, let's dive right in. First time on SF Live, really appreciate you coming on. You introduced yourself as a strategic investor, and that actually opens my first line of questioning, actually. It's like, and gives you an opportunity to introduce yourself as well. It's like, how do you define yourself? You said strategic investor, and what does that mean to you?
Well, I'm not super comfortable with those kinds of labels because I think they oversimplify. I would actually say I'm probably a tactical investor, but I think that the market wants to call you what the market wants to call you. I come into companies, take big stakes in them, and I often step in and assist management, usually on the finance side of the business, but often on the strategy and tactics side of the business. Usually that's done behind the scenes, but occasionally I'll go over 10%, and very occasionally I'll take board seats where it's desired and necessary.
I googled your name before this conversation, and you said sometimes you come in, but I haven't seen LHI Capital or Lotan pop up really in the last 9-10 months. I think the last one was really you added to your Aurion shares. Run us a bit through like what you've been working on behind the scenes. Like you don't have to share names, but it's like what have you done? Like what have you looked at, and how have you placed LHI in yourself?
Sure. So I'm typically not going to go over 10%. That's a huge impediment to the liquidity of your position. I went over 10%, I think, on 3 investments over the course of the long bear market that we had, or I got very close to going over 10%. And in some cases, I would go over after markets had improved. In the case of CBG in Quebec, for instance, they had a discovery. At least it seemed that way to me. I still think that's probably the case. So I went over 10% and sat down with Jack and suggested that perhaps I could give him a hand on the finance side if he wanted to give me a board seat, and he did. And that's the way that started. Was over 10% on a phosphate deposit in Northern Ontario. Mostly just to clean up the stock over the course of many years, and behind the scenes, Steve Case and I talk about strategy and how to run the business, and we would experiment or discuss a variety of strategies for that company, but never needed a board seat, and would never have been. There was nothing more I could do other than discuss strategy and tactics with Steve on a regular basis, and buy more stock, frankly, to clean up the weekends.
Interesting point. You mentioned like liquidity not going over 10%, but then you said you also ask for board seats from time to time, right? So, which is actually a huge impediment to liquidity, because theoretically you shouldn't or you can't sell as a director because the optics are just bad. Sure. You still can, but the optics are bad, right?
Well, and so generally I don't ask for board seats. Normally I'm asked to the board. In one case, I made the suggestion, but I didn't think that Jack would, and we had a long discussion, and Jack decided that it was a good idea, and it was his decision. But in the normal course of operations, that's not a good idea. That makes you super illiquid. In the case of Orion, for instance, it was likely that the company would need to raise substantial funds, and it was likely that the company would bring in a strategic investor. And I thought that those situations really needed to be addressed by someone with experience in that area. And Mike recognized that as well. So that's really been a totally collaborative effort, certainly not to my benefit from a liquidity standpoint, but I think in the long run, it will be the right thing for everyone.
Yeah, no, it makes a lot of sense. Like bringing that expertise. I see so many juniors that are just dead in the water because they actually don't know what they're doing. They're run by a geo. and it just doesn't make any sense. Having you here is like strategic investor. You said you used the bear market for some positions. I told you before we went live, it's like I don't really want to talk about the last few months. It's just so doom and gloom, and I'd rather look forward, and titled the video sort of a roadmap to successful investing. So I do want to look forward and discuss with you in a second what you're looking for when you're investing, and what we should be looking forward to, maybe some of the indicators. But going back, let's recap the last few months. And I know you just came back from a fishing trip as well. What was with some industry bigwigs there? Like, what was the mood there? Like, how are they feeling? And give me some of your impressions there.
Well, I think it was sort of a tale of two markets. While we were there were a couple of fellows there who were dealing with some very difficult problems that were specific to their companies. And there were some fellows there who had been involved in one of the recent high profile mergers at the top of the industry. And I think the mood was generally good. I think to put a theme on it, we all agreed that mergers and acquisitions are likely to pick up over the next few years, that the industry's need to replace its reserves is growing ever more urgent. And I think we're all positive on the development of that second market, the market that travels in parallel, but above this market that we're in. You'll see more and more Great Bears or Pretiums or Rocks Golds or Oklo. In Mali, you're going to see a lot more acquisitions going forward, and of course, those are going to be at levels that are required to clear those deals. You can see those prices are often very high, and the junior markets will eventually be dragged up by increasing frequency in mergers and acquisitions and higher prices in mergers and acquisitions.
Interesting. Yeah, it's like, I spoke with a royalty corp dev guy in Toronto. You know him well as well, and he said he sees a lot coming down the pipeline as well in terms of M&A. And now I'm asking myself, like, where do we see that happening? Like, just looking at the market again today, all the developers are being crushed. Ascot comes to mind. Rio 2 has issues down in Chile. Ascot is not being able to secure their financing package. Like, where do you see M&A taking place? Is it early stage explorers? Is it the developers? Do the producers need to consolidate? What's your opinion?
Well, if you look at the recent merger of Yamana and Goldfields, and then go back to Kirkland Lake and Agnico, these make large companies into mega large companies and create very large production profiles, which means you have a very large pipeline, or your pipeline needs to greatly expand. And it isn't totally clear where those projects are going to come from, but most of them are very likely in public domain now. Ascot is a great example. Skeena is a great example, a very interesting asset out there. And then if you start to look in the US at companies like Liberty Gold, Gold Standard Ventures, of course, has just been taken over by Orla Mining. And I think that a lot of people thought that would be a stranded asset, and were scratching their heads about what the future would be for that company as they were in a long permitting trough. And yet there it is. Finally happened after all these years. And I mean, I've been in touch with the Gold Standard situation for many years, and Jonathan Ott is a friend, and I greatly admire him. And I think that you'll start to see all those assets begin to clear over time, and probably the development cohort is a great place to look right now. The Rio 2s and the Liberty Golds, and maybe Perpetua, I guess that used to be Midas. Those sorts of things will likely clean up first. But I thought it was fascinating and interesting that Great Bear went pre-resource. So anything that looks large and looks like it can have a multi-decade mine, whether it's already in development or not, I think you'll see those things go quickly. So who knows how long it'll take for Filo? I mean, it's hard to know how large that is.
Good point, actually. They're still drilling and finding new porphyries all around the project. So amazing discovery, and a great example of how discovery doesn't recognize the bear market. I mean, they're down from $27 or $28 to $20 today, but they got their $100 million in from BHP. I think mission accomplished there. It's Nice
maybe going
stamp
to
of
be
approval.
maybe it's going to be the Voisey's Bay of this particular decade. Credible discovery, but of course there's still Sol Gold in Ecuador. Lots of major interest in that. Probably retreated a little bit on Nick's strategy there, and then there's Solaris as well. So the big multi-decade opportunities are very well bid still, even in this ugly market. And the pipeline requirement is so large, it's just going to drag up all these developers.
Actually, good point. Good point you're making here. Discoveries as well, like Philo. Last year, and we raised about $6.8 billion for the juniors. Right.
Mm-hmm.
Do you think the money's being well spent? Because for me, and that's more of a gut feeling than anything, is like we're not making as many discoveries as we potentially should. But I might be wrong on that, and probably like misjudging some of it, because we see a lot of infill drilling, a lot of brownfields exploration, but not a lot of like greenfield wildcat drilling as well. Is that your impression as well, or am I completely off?
A lot of that money gets sucked up by the larger, more successful developers. So of the 6.9 billion, I don't know how much, for instance, would have gone to Osisko Mining or Osisko Development, Silvercrest, that sort of thing. So those are discoveries in progress. I mean, I think perhaps that figure would include the convert that Northern Star put into Osisko as an example. So you don't expect more discoveries to come from that kind of money. Discoveries are very difficult. You don't know when they'll arrive. Getting in front of them is a euphoric experience, and really the only way you can do that is by investing in teams and land packages and companies that have the ingredients for discovery. After the fact, you're going to pay a pretty high price sometimes. I mean, a lot of discoveries draw capital at great prices, and that's great for shareholders. When existing shareholders, when the incoming guys pay a good price. So I'd have to really look at that number in a more granular way to determine whether it's productive or unproductive.
No, good feedback. Like because the numbers do suggest like the Osisko Minings of the world, the developers are sucking up that. So that's a really good point. But the Philo is standing out and overshadows a lot of it, right? So I was like, oh, why don't we have more Philos? When I look at the numbers, well, it's also exploration, right? It's not like really you go somewhere, pick up a piece of rock, and you have that massive discovery. It's a little more difficult than that as well. Let's talk sentiment for a minute here. It's like, and as I said, I don't want this to be a doom and gloom conversation, and everybody jump off a bridge after we hang up here, right? But let's talk about junior mining, the developments of the last few months, what has been weighing on the sector, and then I want to talk to you about like what might change over the summer. Hope, fingers crossed, or what are some of the things you're looking for when what factors of change or black swans or whatever you want to call them. Let's recap the last few months first, though.
Sure. Okay, so year to date, I think the NASDAQ is down, let's say 28%. The S&P is down 20%. And we've approached yield levels on the US 10-year that are similar to the yield level that caused Powell to blink in 2018. Credit spreads are now getting very close to where they were in 2018 when the Fed last abruptly reversed course. So financial conditions, to me, seem to be nearing levels that are similar to those where the Fed last blinked. And I think that the narrative going into this year was that the Federal Reserve couldn't raise interest rates aggressively because it would break the economy. There's a whole bunch of other factors weighing on us now. Inflation was bubbling up to begin with, especially related to energy. Inflation kicked up very hard in relation to the war in Ukraine. And we're seeing the venture capital and the growth sector in the United States breaking in a manner that's very reminiscent of 1999 and 2000 and the dot-com crash. So against that backdrop, it's very difficult for speculative stocks to perform. Companies that only use money until they produce wealth don't fare very well in periods of uncertainty. And it isn't necessarily what they're doing on an individual level or even the sector. It's just when a company is going to need to raise money at some point in the future, when it's clear that markets are not necessarily going to be cooperative in supplying that capital, investors will run away from that sector. And then that's where we are today on venture stocks.
Yeah. Is there a single main factor that's weighing on the mining stocks as well? Like, or are we just being held captive with the rest of the market while gold is holding up actually fairly well?
Mm-hmm. Well, certainly, just let's move over to hydrocarbons for a second. So that sector is probably up 20 or 30 times from its COVID bottom. You can't talk about that because, of course, it's not politically acceptable in this day and age. But what a secondary result of that run up in those stocks is discussions of price caps and price controls. And that takes us all the way back to 1971 and the Nixon shock of wage and price controls, which was largely, I think, driven by Nixon's desire to get reelected in 1972. But those discussions are happening now. They're almost always popular and politically popular when they happen. But almost every rational financial actor understands that it only leads to scarcity and really difficult economic times, which is what happened after wage and price controls were implemented in the 1970s. So I think that there's a lot of concern at the moment about that. And there's a crossover between all natural resource investors, from mining to hydrocarbon investors, and that is probably weighing on the sector, among other things.
Interesting. Like, I made the comment, or I often repeated myself, even conferences, personal conversations with people, that I thought, like, you need to scare the 401k money to get a boom in mining stocks. Mm-hmm. Now we see 401k money scared, like Nasdaq's down 30%, the FANGs are not delivering anymore. They should be reallocating, but right now it feels like they're sitting on cash and not coming into the miners. Mm-hmm. What do you think might trigger that? Let's look at the positives. If we talk the negatives, like I want to have a bit more of a positive conversation here.
No, but, that's a great discussion. We talked about this offline. My model for today is 1999, 2000, and part of what I do as an investor is look at all past markets that I would consider to be multi-year markets, and think about how today's conditions resemble conditions then, and what happens after, what happens next. That's really how you make money in this business. It's not guessing or predicting what happens next. It's really just going to the second derivative and predicting what happens after, what happens next. And I think what happens next is potentially a long bear market in growth stocks. They're already, in some cases, down 70 to 90%, especially these TAM, or total addressable market, stocks in the United States. And when you think about the implications for that, even on inflation, one of the aspects of inflation that the market probably hasn't recognized is that for the last 5 years or so, investors in Silicon Valley or venture capitalists or crossover funds like Tiger Global have raised many billions of dollars to support companies that are subsidizing consumer purchases with negative unit economics. And I think that if someone boiled their investment or their business plan down to, I'm going to raise a whole bunch of money from VCs and endowments in order to pay to deliver food to teenagers who are sitting at home during the pandemic and collecting CERB, people would think that that was completely and totally insane. But that's where we are today. And so a lot of those companies still have multi-billion-dollar market caps. And the good fiduciaries, the good financial advisors, the smart ones, will just take their losses and look for sectors to invest in that can provide forward returns. Energy is going to be a difficult place for those investors to go to because it is so politically unpopular, despite its obvious necessity. And I think the mining stocks will be a great place to look, not just for forward return, but for safety, which is going to be a very preservation of capital is going to be a very big theme for the next few years, assuming that many of these growth stocks, well, they're down on average by 30%, or more specifically down by 50 to 70%, they still have a long way to go. Many of these things are still trading at 10, 20 times revenue. By the time the growth stock bear market was over in the middle 2000s, companies that went from trading to multiples of revenue to multiples of earnings, and companies that didn't have earnings went to zero.
Interesting to watch that, like Peloton, and one is the biggest example that comes to mind. There is
it is the
stay-at-home economy is just crumbling, and I'm not sure how it is sustainable to order blizzards from Dairy Queen over Uber Eats. How that business model is going to work with $2-3 delivery fees. Really interesting. We see that a lot, and one thing that came to mind as well, for risk-on investors that want to come in more down the pipeline, junior mining stocks as well, it feels like there's not a lot of competition out there right now. We had to deal with cannabis, we had to deal with crypto, but it feels like there's no other trend that might deter us, or they might deter investors right now from coming back into junior mining stocks. NFTs are dead, cryptos are crumbling. Bitcoin is still taking some attention, but it doesn't feel like a hype topic anymore. Do you concur? Do you see other trend topics maybe popping up as well? Something I don't even have on my radar.
I don't, but I'm a supply side investor, and I like to look at areas where supply has been disrupted, and in particular areas where the supply of capital has been disrupted. And it would be hard to find a sector that has been starved for capital in the way that natural resources has been starved for capital for the last 20 years. And usually what that means is there isn't enough copper, coal, met coal, let's choose met coal, natural gas, let's choose natural gas, or critical metals, fertilizer, that sort of thing to go around, even if you go into periodic global recessions. I mean, the supply of capital to these projects has been epically disrupted. And it's very, very hard to know whether or not existing mines will continue to be able to supply needs. Because even if you look at the great copper mines in Chile, many of them are 100 years old. A lot of them are going deeper into portions of the deposits that are very high in arsenic or other deleterious elements. And so I think that it's a pretty good setup. Now, I think capital is going to have to flow into the sector. And I think that people who are already in it, even though it's tough right now, will be the beneficiaries of those forward flows.
No, definitely. As well as the trend is your friend when it comes to EV investing, critical metals. I think I include copper actually in that as well.
It's very hard to play the Keynesian beauty contest. We all like to look at companies and try to determine some concept of fundamental value. But the reason stocks go up is because more dollars come in than dollars exit. And I have looked at this sector for years and thought that it really was, it really has had the most anemic inflows that I've seen relative to the rest of the economy since maybe the 1970s. And I think that though this area will need significant capital in order to meet society's goals going forward. And I think that bodes well, but it will not be a smooth ride.
Interesting. Somebody posted on Twitter this morning the cash positions of all the tech stock, or of many of the tech stocks, like in Apple. They're close to $200 billion in just cash. That's not working capital. That's just cash, and that is just insane.
Imagine when they start hedging their supply chain.
Yeah. No, exactly. That's exactly what I mean. If they start deploying some of that and using it to secure future revenues, it's a bit of mind blowing. When you wake up in the morning, Dave, what are some of the indicators? What do you look forward to? Let's say you open Financial Times. What is one of the headlines, or what is something that you look for? Do you check the US dollar price or the DXY? Do you check oil prices, gold price? What's the first thing you look at? And what is something, what could be an indicator for change and sentiment change in the sector for you?
Credit spreads are the most important financial variable for all markets. And you really don't need to, if there's only one number that you're going to look at on a daily basis, or two numbers, you would look at investment grade credit spreads in the United States and Europe and high yield credit spreads in the United States and Europe. It's when those measurements, especially high yield credit spreads, go parabolic, that you see the Fed make some move to change the direction of policy. So those would be the most important numbers for me. Usually crashes in financial markets happen when there's a sudden withdrawal of credit from a particular sector. So you go back to 1998 and the Russian credit default, which was about a year after the Asian crisis, and all of a sudden you had long-term capital unable to roll its trades, which was a huge deal at the time. I mean, it's ridiculous now to talk about it because it was only a $2 billion fund. But the dominoes started to tumble, and eventually a large player in the financial industry couldn't borrow anymore. And that was very quickly dealt with by the Federal Reserve, but it caused severe market ructions for some period of time before and just after. And then, of course, the entire mortgage sector of the United States had credit withdrawn abruptly from it in 2008. And that had a knock-on effect with the banks and with the big insurance companies that had insured some of the synthetics associated with that business, going all the way up to AIG, which was the biggest, longest held AAA borrower in the United States at the time. And when Powell decided to pull out all the guns in 2020, it was really driven by corporate credit spreads. And they went in and they bailed out the corporate bond market. And to some extent, they even came into treasury markets. So that's the big number for me. And then from there, I mean, you look at the futures every morning to see where the big indices are going. And you look at the Japanese, German bond markets, that sort of thing.
Gotcha.
The 10-year yield would be number two in the United States.
The negative interest, the real yields right now are just mind blowing, and the spread between the 10-year bond interest rate and the inflation as well.
I would add, the last time the Fed abruptly changed course from hiking rates to reducing interest rates was 2018, and high yield spreads were about 530 over at the time, and that's where they are today. I don't think this would be the point where the Fed would blink because inflation is so high, but we're getting to a very interesting level there.
Are we going to see 6 more or 7 more rate hikes this year, or the next month? Is that still a reality, or do you think they'll have to pull the plug at some point?
Well, I did notice Elizabeth Warren, who's been one of the big financial hawks and has been super critical of the current regime, is now publicly imploring Jerome Powell not to take the U.S. economy over a cliff. And I think one of the things that the Fed needs prior to any intervention is they need those who have been negative towards them and their policies to beg.
Okay. And it seems like they're doing that as well. It seems like it's happening. So interesting. I want to take it back to junior mining for a second to sort of wrap up the conversation as well. I want to talk a bit about how do you see the summer playing out, and also Labor Day always seems to be that day that the big trend change is going to happen, whatever it is this year, September 7th, 5th, or whatever it is, right? It's going to happen. If I feel like talking to corporates, at least there's a bit of a better mood sentiment towards the fall. What's your opinion? What do you recommend? Should I lock up shop, come back August 15th, and take a 6-week holiday right now?
Well, doing nothing is often a good strategy. However, I like where we are right now. I think that most of the big producers have great balance sheets, and they're making really robust free cash flows. And you really can't have the junior sector continue to decline when the seniors in the sector have giant pipelines to replace and are making good money and are not in financial distress. I mean, I guess I would exclude a couple of them there. I mean, IM Gold unfortunately crossed the line, and they've gone perhaps to the point of no return. Maybe that company will need to be broken up, and that's a cautionary tale for the industry. Kinross doesn't want to be the next IM Gold, and B2 Gold doesn't want to be the next IM Gold. And I don't think that's likely with those companies, but it's a perfect example of what happens when you don't adequately address your pipeline issues going forward. So I think now is probably the time to be buying stocks. If all of a sudden gold went to $1,500 and the producers were not for instance, making these kinds of margins, you probably have to adjust that strategy. But across the board, whether it's copper miners or nickel miners or gold and silver miners, everyone's doing pretty well. And there's a lot of noise right now around their costs and around the inflation in their cost basis. But I think that inflation may have peaked, especially when it comes to energy. I'm not so sure about that one, actually. However, we're probably closer to the peak inflation for input costs than further. And nonetheless, their need to replace their pipelines is growing more and more urgent. They just can't put this off for another 5 years. So I think, you need to leg into stocks, but these are the times to buy.
Choose one of the three, Dave. Explorers, developers, producers. Which one should we buy right now, based on what you just said, with keeping inflation in mind, for example? Mm-hmm. Choose one category. Where would you deploy your cash?
Yeah, I think that all depends on the price that you're paying for an individual name. So in my own practice has been to focus on exploration and to spread my bets across a variety of solvent companies with good people and good land packages, so that I'm statistically more exposed to discovery. But you do need to pay a rational price for those. And we're probably getting pretty close for a lot of these names. The development cohort, however, I think is dead easy, super cheap right now. And there's a lot of good stocks out there run by good people that are solvent, that have 1 or 2 years worth of cash in the bank. It's probably a very easy place to look at the moment. And I guess if I had to put a weighting on anything, copper gold stories where you've got a copper gold porphyry, I think those are going to be extremely popular assets with the majors going forward.
Dave, so I knew why I was looking forward to this. There was a reason for this, and I tremendously enjoyed our conversation. We've been chatting now for over 30 minutes. Really appreciate it. I have a few more questions actually lined up here, but we've got to cut here. We got to invite you back maybe around Labor Day, actually, see how the summer played out, and come back to what we discussed here. It was immensely insightful. Really appreciate your time, and thanks so much. Have a great summer, and we'll catch up definitely around Labor Day.
Thanks so much for putting this platform together and getting these kinds of voices, not mine, but the Nikki Bells, the Brent Cooks, the Matt Geigers, getting all these really interesting people out to the world. I think it's really, really a great thing you're doing, Kai.
Fantastic. Really appreciate it, Dave. Now I'm blushing a little bit. So good thing we're not broadcasting at 4K here. No, thank you so much. And let me switch over real quick and thank everybody else for tuning in. This is highly appreciated. Make sure to hit that like and subscribe button. And I know roughly 85% of you are not subscribed to this channel who are watching. So please change that. It helps us get the message out more, provide more quality information, and get more high profile guests on like Dave Lotan as well. And I really appreciate that. Thank you so much. And we'll be back with more live content very